at an example to do journal entries. This is exercise 4-3 in your textbook, which refers back to the transactions in exercise 4-1 or 4.1 on page 130. So it says the transactions relating to the formation of Blue Coast Stores Inc. in its first month of operations follows. A. The firm was organized and the owners invested cash of $8,000. So let's do an analysis here. Remember, every transaction needs a debit and a credit, and that may increase or decrease the appropriate account depending on whether or not it's a debit or credit. So if the form's organized, we're forming a new business and the owners invest $8,000 cash in the business, that means we're going to receive $8,000 cash. So if you think back to your personal life, when you receive cash, does your cash balance go up or go down? It goes up. And the way that we increase cash is through a debit. Cash is an asset. Assets increase with debits. So we debit cash for $8,000. And we credit, what are the owners going to get in exchange for that investment? Well, they're going to get stock. So we also call, that's a component of paid in capital. So we will credit paid in capital $8,000. All right, moving on. B, the firm borrowed $5,000 from the bank and a short-term note was signed. So again, if you go to the bank and you borrow money, what do? They give you a check that you can take and put into your own account or give to someone else. So again, our cash is going to go up by $5,000, and in exchange for that loan, we now owe them. And when we owe someone something, what do we call that? We call it a liability. In this case, it's notes payable. So our notes payable are going to increase by $5,000 because liabilities increase with credits. How about C? Display cases and other store equipment costing $1,750 were purchased for cash. Okay, so we know, and it goes on to say the original list price of the equipment was $1,900, but a discount was received because the seller was having a sale. Well, I don't care what it retailed for. I only care what I purchased it for. That's all we care about in accounting, what it actually cost, not fair market value, not what it should have been, what we actually paid. So anytime we pay cash, we have to credit cash because cash is an asset. Assets decrease with credits. So our checking account's going to go down by $1,750. And in exchange, we're going to receive equipment. So we will go ahead and debit equipment here, $1,750. Again, equipment is an asset. It's something we own. It has value. It increases with debits. All right, D, a store location was rented and $1,400 was paid for the first month's rent. So if we pay, just like we paid for the equipment in C, we credit cash for $1,400. So sometimes if you can figure out one side of the equation, you know what the other one's going to be, even if you're not sure. And so if we paid, in this case, rent expense, $1,400. All right, how about E? Inventory of $15,000 was purchased. $9,000 cash was paid to the suppliers, and the balance will be paid in 30 days. Okay, so we are bringing in $15,000 worth of inventory. What kind of account is inventory? Inventory is actually an asset, so assets increase with debit. So we'll debit inventory for $15,000. And it says we paid cash. Again, anytime we pay cash, we know cash is credited for, in this case, $9,000. The difference between what we received and what we paid is a liability to us. We now owe $6,000 on that merchandise inventory, and that's a liability, accounts payable. So our liabilities are also going up now by $6,000. Okay, let's go to F here. During the first week of operations, merchandise that had cost $4,000 was sold for $6,500 cash. Okay, remember, under a perpetual inventory system, we will have two journal entries. We need to record the sale first. So we sold merchandise for $6,500 cash. Then we'll have to record taking it out of our inventory and charging that to cost of goods sold. So in this case, we get a debit cash, I believe, for $6,500 because we're receiving cash on that sale. And we will also record the revenue. That's how we make money. We sell product, merchandise. And then we need to take it out of our inventory. So inventory, we saw up here, was debited when we brought it in. So in order to get rid of that inventory, now we need to credit it because it's an asset. Assets decrease with credits, and that was for $4,000. And then we charged that cost of that merchandise to an expense account called cost of goods sold. Debit our expenses, that increases our expenses $4,000, sorry, cost of goods sold there. All right, G, a newspaper ad costing $100 was arranged for. It ran in the second week of store's operations. The ad will be paid for in the next month. So we're not paying cash today, we're going to pay for it next month. So what do we call that when we owe? It's a liability. It's going to be accounts payable. So we'll debit our advertising expense for $100 and we will credit our accounts payable $100. Okay, H. Additional inventory costing $4,200 was purchased. $1,200 cash was paid. The balance due in 30 days. Okay, well this is a repeat of what we did in E, just different amounts. So we bought more inventory. We need to debit our inventory $4,200. That will increase that. Credit our cash for $1,200 because that's what we actually paid out. Decreases our cash. And then we increase our liability accounts payable by an additional $3,000. How about I? In the last 3 weeks of the first month, sales totaled $13,500, of which $9,600 was sold on account. The cost of goods sold totaled $9,000. All right, this is very similar to the previous sale that we had, which was on F here. The only difference is we're not receiving cash now. $9,600 was sold on account, so we didn't get it all up front. So let's go ahead and take care of that. Well, $13,500 in sales. We know to increase our revenues, we must credit our service revenue. I believe that said $13,500. Then $9,600 was sold on account. So when customers owe us money, that's an asset. It's called accounts receivable. So in order to increase that asset, we have to debit it. And then the difference between the two, which is $3,900, I believe, will be debited to cash. All right, and then we have to go ahead and take that out of our inventory now. So we know we're going to credit merchandise inventory, debit cost of goods sold for the cost of the merchandise. Let's just see, how much did it cost us? The cost of goods sold was $9,000. Debit $9,000, credit $9,000. Debits always have to equal credits. J, let's see, getting close here. Employee wages for the month totaled $1,850. These will be paid during the first week of the next month. Okay, so we're not paying them right away, but we've incurred the expense, so we'll debit wages expense for $1,850. And since we're not paying out cash immediately, we've now incurred another liability. Wages payable means we're going to pay our employees at a later time. We owe them, so we'll credit that. That increases our liabilities. Okay, the firm collected a total of $3,160 from the sales on account recorded in transaction I. Well, when it tells me something happened in a different transaction, I always want to look back and see what happened. So in this case, we sold merchandise, part of it was on account, and it says we collected $3,160 in those sales. So out of this accounts receivable, we're not collecting $3,160. So we need to credit our accounts receivable $3,160. That will reduce it. And yay, they're paying us, so we get to debit cash. Increases our cash. I like it when my cash goes up. Wish it happened more frequently. All right, how about last one? L. The firm paid a total of $47.20 of the amount owed to suppliers from transaction E up here. So let's go down and see, what did we do? Oh, okay, we purchased merchandise. Part of it was on account. So now we're going to pay $47.20 of that. So we had credited accounts payable. So we need to debit now accounts payable to reduce that liability. And unfortunately, cash will go down for that payment, so we have to credit cash $47.20. Hope that gets you started analyzing transactions. Thank you.